Okay, good afternoon, everyone. Thanks for joining us this afternoon. My name's Brian Hirschberg. I'm counsel here with Mayor Brown, and I'm joined by Zach Dombrowski from BMO Capital Markets, and we are going to be covering at-the-market offerings today. Before we begin, a few housekeeping matters. You're all muted as part of joining today's WebEx, so please ensure that your lines remain muted during the presentation. We'll leave a bit of time at the end of each section for questions, but we're happy for you to interject with questions during the presentation. You can unmute yourselves to ask a question or type a question into the chat box, which I think is at the bottom right of your computer screen. For those seeking CLE credit today, you should have received an affirmation form and a evaluation form along with the connection details. We'll announce the CLE code for today's session during the middle of the presentation and also at the end of the presentation. So please return all the CLE credit forms to the Mayor Brown address that's provided on the form. So with that said, I'll jump into today's presentation to start with a brief overview of at-the-market offerings on slide 2 here. And after I cover the overview, Zach will jump in and discuss the current market environment for ATM offerings. So an ATM or at-the-market offering is an offering of securities into an existing trading market for outstanding shares of the same class at other than a fixed price. So the shares are issued on a national securities exchange, so such as the New York Stock Exchange or one of the tiers of the NASDAQ. And so therefore the price at which the securities are sold in the ATM offering will inherently vary because it is based on the price of the issuer securities at any point in time as they trade on that trading market. So next slide. Now that we have that basic definition, slide 4, on this slide we compare a basic ATM offering to a more conventional, traditional underwritten follow-on offering. As I mentioned in the ATM context, an issuer sells newly issued securities into its trading market through a designated sales agent at prevailing market prices. Conversely, in a follow-on offering, the shares are sold in a bullet or single offering at a fixed price that is determined really by the participating investors' interest in the securities. So unlike a follow-on firm commitment offering, the ATM can be done on either a agency best efforts basis, or it can be consummated on a principal firm commitment basis, as is typical in the traditional follow-on context. Most, if not all, ATM sales are undertaken on an agency basis, but the structure does provide flexibility for both typically. So next slide, slide 4. What are the benefits, right, of the ATM program? ATM offerings offer several distinct advantages over traditional offerings, including minimal market impact. Issuers have the ability to quickly raise capital by selling those newly issued shares into its natural trading flow of the market without having to make a public announcement for every takedown that they do or announce the offering. The public announcement is done at the time the ATM is established, and then quarterly thereafter, the issuer announces how many shares have been sold and the proceeds raised pursuant to the program. But the market impact is minimized by any sort of by the lack of notice of a public takedown. Flexibility is another advantage. As I mentioned, sales can be effected on either an agency or principal basis. So the terms of each of those sales need to be agreed upon in advance by the issuer and the sales agent, including the timing and the size. Both of these then remain at the issuer's discretion, as opposed to an underwritten offering that the public announcement of it, the horse is essentially out of the barn on that. After that happens, then the investor demand becomes very, very important, as opposed to allowing the issuer to have more discretion on when to take shares down off of its ATM. This enables an issuer to essentially match capital needs with capital inflow. An issuer can implement a limit price below which sales won't occur. And it could also put in a percentage limitation on daily sales to reduce downward pressure on its stock price. So there's a lot of flexibility in the stock sales there. Another advantage is lower offering expenses. Distribution costs to make the ATM issuance is typically less, more along the lines of the 1% to 3%, as opposed to a traditional follow-on offering, which will typically have a higher underwriter fee associated to it. And then minimal management involvement. ATM offerings, unlike traditional follow-on offerings, don't have any sort of roadshow or management participation to a large extent. And lastly, as I'll cover later, ATM offerings have now been structured periodically to include a forward sale option. So this forward sale allows the issuer to sell its securities through the ATM offering today at current trading prices without actually issuing any securities. So those settlements are done at a future point in time, 6 months, a year later. So that's another potential advantage. Quickly, some disadvantages of the structure. ATM offerings tend to be substantially smaller in size, so the proceeds that are received are typically a lot less than in a traditional follow-on offering. And the program may not be as useful to issuers that are seeking to raise a significant amount of capital in a short period of time. And there are also ongoing expenses that are incurred with respect to maintaining an ATM program. As we'll talk about, legal opinions and comfort letters need to be delivered on a quarterly basis. And so these costs make regular ATM issuances a little bit more expensive on an ongoing basis, especially if the issuer is not really taking advantage of the ATM regularly. So next slide, slide 5. ATM offerings, have, as Zach will touch on in a second, have become more and more common recently. And they are especially useful for those issuers that have a frequent need for capital. So these are real estate investment trusts, or REITs, in particular mortgage REITs. These are entities that are required to distribute in excess of 90% of their net income as distributions to shareholders. And so they are in a constant need of raising capital. So ATM programs are especially popular for them to make sure that they have an extra tool in their capital markets toolkit there. Biotech companies as well, especially those companies that do not have a clinically approved, drug, and do not have any, income coming in from any approved drugs. And they're, if they're involved in ongoing clinical trials, they need to continually raise money to progress their drug candidates. So biotech companies, along with energy companies and utility companies, are also frequent users of the ATM. But more broadly, any issuer that's looking to engage in regular balance sheet maintenance, have another organic growth opportunity, or maybe can use the product to finance a smaller acquisition. Lastly, affiliates, as I'll talk about later, very often use an ATM to sell securities in a registered transaction. We find that beneficial as well. So with that, basic rough overview of what an ATM is and what it can offer issuers, I'll turn the presentation over to Zach to talk about, a market overview with respect to recent ATM offerings. So Zach.
Thanks, Brian. And if we could just go to the next slide. So by way of introduction, my name is Zach Dombrowski, and I'm a vice president with BMO Capital Markets. I cover consumer and industrial companies primarily, but have a lot of experience in other sectors as well. I've worked with Brian on numerous ATM offerings, and similar to what he discussed, the market for this type of execution has grown significantly, partially due to COVID and the pandemic, but also more and more issuers in varying sectors are realizing the benefits of this execution alternative versus the this discrete marketed or bought follow-on offering execution. Like Brian said, traditionally the ATM was the domain of REITs, of energy companies, of healthcare companies that are capital intensive by nature or constantly need capital and don't often have access to other forms of, whether it's debt capital or bank capital. However, in recent years, we've seen many different issuers in other sectors consider this alternative, primarily in some of the more sensitive sectors to the pandemic. Think restaurants, think retailing companies, and then also industrial companies who have murky outlooks on their ability to forecast the next couple of years and prefer to have the option available to them should they need to raise capital. The ATM as a total percentage of follow-on offerings is quite large. This year we're over 40%. That's significantly higher than it was 10 years ago at around 20%. You can see on these two top graphs, just the alternative has exploded as a way of choice for issuers to raise capital. And the pie charts on the bottom just go into additional detail around how, over the course of time, it's transferred over from REITs and energy to a more diversified sector exposure. Next slide. So this page, it covers a lot of the things Brian has already talked about and on the pros and cons of the alternative, why issuers think about this as a way to raise capital. Obviously, they like the reduced cost of equity financing. They like the flexibility. They can dollar cost average into their stock price and be more selective around when they issue. They can minimize the dilution by being more selective around that stock price. And then, of course, it saves a lot of management time in terms of preparation, unlike a marketed follow-on. Granted, we don't do them anymore because no one's traveling, but traditionally you may be on the road for 2 or 3 days talking to investors. While on the ATM, you can just put it in place and sort of give your instructions to your underwriter or your agent rather, and be on your way. Again, when we talk to clients, we've often focused them on the speed in which you can raise capital under the ATM. It very much is governed by the trading liquidity of the issuer. For a lot of smaller cap issuers, it can be a struggle to raise meaningful amounts of capital under an ATM. Although you still can have opportunities for reverse inquiry or Reg M trades where you can print blocks of capital off of an ATM shelf. However, we advise clients that you can't always count on that as a way to raise capital. In terms of the disclosure strategy, a lot of issuers, especially companies and sectors that aren't used to this type of execution, ask us questions around what they should disclose when filing an ATM. And quite frankly, it's merely just the prospectus. Sometimes issuers decide to press release it. That's very much up to them on what kind of signal they want to send to the market. And then in terms of ongoing disclosure, of course, you have to include in your queue, if you've issued shares underneath the program. Next slide. So this is just a checklist of the documents and the work streams that issuers and counsels and agents would need to undertake to put a program in place. Obviously you need a shelf registration statement. You do need a prospectus supplement. One thing to note is that when filing an ATM, you almost always file a dollar amount versus a share amount because you're issuing shares at continuously different share prices. The distribution agreement, or EDA, that is the form of agreement that governs the programs, very similar to an underwriting agreement. And then, of course, regular way due diligence as related to any sort of equity underwriting. You'll do business, legal, financial, environmental, any sort of typical diligence you would do for a regular offering. And then obviously the comfort letters. Ongoing quarterly diligence, I think, is a very important item to understand when it comes to ATMs, particularly for issuers who maybe they haven't done an ATM before. Maybe maybe they want to learn more around what an ATM is and how it can help them. Because you do need to conduct quarterly diligence every quarter. It's important to have issuers understand that this means, it will be a time requirement. It will be a expense requirement to conduct that diligence. It's not something that they can take for granted because the agent is taking, that agency risk around this offering, and it is a very important consideration. And quite frankly, many issuers, particularly those who are new to the alternative, they may not have a solid grasp of what it means to have MNPI or other information that they're in possession of when they're directing an ATM to be traded on. So that's something that I think a lot of the banks out there are a lot more focused on than they used to be, just given that we have management teams that are a bit more green with the product. And, as you get closer and closer to blackout periods, we increasingly find that management teams need a little bit more coaching around what it means to issue into those blackout periods and why it's important to pull back at certain times and things of that nature. Next page. This is just a quick overview of the timeline. In my experience and with Brian's help, we often put these programs in place in about 2 to 3 weeks. I think 2 weeks is sort of the minimum you'd want to allow yourself to put a program in place to get all the work streams going. I have seen them done faster. However, you just want to make sure you're doing your diligence and making sure everyone has enough time to go through the documents. I would say 3 weeks to a month is more than enough time. It's very similar to a regular equity offering where you'll have an org call. They're very brief. You run through the details of the program, identify who's doing what, and sort of move on. And the legal teams, both on the company side and the agent side, will go off and do their work. And it's actually a pretty seamless process for everyone involved. Probably the heaviest lifting item for the agents and the management teams is going to be around the diligence, particularly if it's a new program or a new client to the firm. You're going to spend a lot of time on that. Next page. Over to you, Brian.
So thanks, Zach. Really appreciate it. I think a question came in that was a very fair description of what an ATM offering is. I do think it is a good equity equivalent to a debt MTN program. I think that's a good way of thinking about it. Now turning to the next slide here on setup. So how do we establish an ATM program? In short, any issuer that is eligible to register its securities on Form S3, that registration statement, if they're eligible to do that on a primary basis, they can set up an ATM program. So an issuer is eligible to offer securities on a primary basis on S3 if it has a aggregate market value of its public float of at least $75 million or more. Or alternatively, if that issuer has issued at least $1 billion worth of non-convertible securities over the prior 3-year period, or has at least $750 million of non-convertible securities outstanding. The only other two exceptions is if the issuer of the ATM securities is a wholly owned issuer of a well-known seasoned issuer, or a WIXI. We'll define that in a second. Or in the context of those real estate investment trusts that we talked about before, if the issuer is a majority-owned operating partnership of a REIT that qualifies as a WIXI, then that OP will also be able to use S3. Many REITs are set up in a UPREIT structure, so that allows flexibility to issue S3 securities at either the OP or the UPREIT entity. So anyway, as I was remarking, how does an issuer qualify to be that WIXI, right? There's more flexibility that WIXIs have to have their registration statements be declared automatically effective by the staff, and to amend their plan of distribution in their prospectuses automatically. So this is a big time saver for issuers that qualify as WIXIs, because they don't need to go through the same SEC review process as non-WIXIs. So what is a WIXI? So a WIXI is an issuer that has been required to file periodic reports under the Exchange Act, has met those S3 requirements that I had talked about, and has a public float of at least $700 million, or has issued at least $1 billion in non-convertible securities over the prior 3 years. So if you meet that test, then you get a much more flexible registration offering process. And that's especially helpful in the ATM context. So next slide, slide 12. So this slide covers the required documentation. So before commencing an ATM offering, the issuer is going to have an effective registration statement on Form S3. Or alternatively, for foreign private issuers, they would use Form F3. So this is a registration statement that's filed with the SEC, and it permits the issuer to establish its ATM program. The issuer needs to prepare a prospectus supplement, unless it had already included that prospectus in the initial S3 filing, which is rare. But typically the pro sup is prepared, and that describes the particular terms of the offering, including the sales agent that's being used, the distribution methods, and the just general terms and conditions of the ATM agreement that's been entered into to establish the program. So following execution of that ATM agreement, the issuer files this ATM agreement along with a press release announcing the launch of the program. These are filed on a current report on Form 8K. So that ATM agreement is entered into, as Zach was describing, between the issuer and the sales agent. Now, I mean, there can be and often is more than one sales agent. They can either sign the same form of agreement. You can have multiple agents under one agreement, or they can sign separate agreements. Although important point, especially for counsel, is to ensure that the issuer is not and doesn't have the ability to engage more than one sales agent at a time. Obviously, they shouldn't be selling at the same time. So as I mentioned previously, this ATM agreement typically provides flexibility to conduct the sales on both an agency and principal basis. It also sets forth the agent's sales commission, and it includes basic legal representations and warranties from the issuer, very similar to what you would see in a typical underwriting agreement. As I'll talk about, later, the agent does have Section 11 liability, and so as a result needs to have the protections of the due diligence that is provided through these representations. As Zach was talking about, one of the more onerous processes from the sales agent perspective is to kind of onboard and go through that diligence process with the issuer. Outside of that, your ATM agreement will also cover termination, how the ATM is terminated potentially by the issuer or suspended, and also provide the agent with indemnification and contribution rights. Finally, the ATM agreement typically will have a fixed date on when it'll terminate and include deliverables, which will typically be quarterly legal opinions and comfort letters. In addition, company counsel and agents counsel will be expected to provide a negative assurance letter covering the disclosure document. So generally, the agreement covers both the setup and the ongoing maintenance of the ATM program, what the conditions are to its use, and the ongoing requirements that the issuer has to comply with in order to make the program available to it. So next slide, slide 13. So as I mentioned previously, the issuer is going to be required to report the number of securities sold under the program, as well as the commissions paid and the net proceeds received by the issuer on a quarterly basis. This is done by means of either a prospectus supplement filing, or more usually, the issuer includes the disclosures in its ongoing periodic reports. So it's Form 10Qs and 10Ks. It'll list how often it has utilized the ATM program. Often, the ATM program will allow the issuer to conduct block trades, which trades are affected at a fixed price. To the extent that an issuer conducts a block, it needs to consider and discuss with counsel whether an additional prosup is required for that transaction, whether that additional prosup needs to be filed beyond the prosup that was filed to essentially establish the program. Next slide, slide 14. So the sales agent that's running the ATM generally will execute sales of the issuer securities through ordinary broker transactions through either the New York Stock Exchange or NASDAQ, wherever the issuer is listed, or the electronic trading system, but all done at varying prices. So as Zach mentioned, the benefit here is that the execution of the ATM doesn't require any special selling efforts on behalf of the agent. So there's no roadshow or any sort of active solicitation process, nor does it involve an amount of the issuer's securities that would be considered significant relative to the issuer's public float or daily trading volume. The commission that is payable by the sales agent is essentially analogous to the commission that is payable to a dealer executing trades, rather than the type of fee that would be associated with an underwriting offering, so an underwriting fee. So based on those various factors, the sales agent execution of the ATM offering in some respects more closely resembles ordinary dealer activity rather than participation as an underwriter in a securities distribution. So next slide, slide 15. So as promised, as mentioned earlier, ATM programs have recently been structured to incorporate a forward sale option. So this forward sale allows an issuer to sell its securities through the ATM at the current trading price without actually issuing any securities. So this new structure is efficient for companies with a current trading price that represents an attractive cost of capital from the company's perspective. And at the company's discretion, it's permitted to enter into an agreement with a forward purchaser, which is an affiliate of that ATM agent, who would purchase a fixed number of the company's securities at a fixed price at any time during the term of that forward contract. Typically, that lasts, as noted there, between anywhere from 6 months to a year. Next slide, slide 15. So instead of selling newly issued securities, the ATM agent borrows already outstanding securities and sells them short into the market. So this option has gained popularity in recent years, particularly amongst REITs, because it ensures the company has that guaranteed cost of capital without needing to immediately issue new securities. The forward sale options typically structured to provide the company with the option to elect cash or a share settlement for all or part of the transaction. If the company elects, it can cash settle, and the market price if the market price at settlement is higher than the forward price, then the company would pay the applicable cash amount, the difference between that market and forward price, to the forward purchaser. And then conversely, the forward purchaser would pay the same cash amount to the company in the event that the market price at settlement is lower than the forward price. If the company elects to share settle, shares with a current value equal to the cash amount, which is calculated in that same manner as noted there, would be delivered instead of cash. So next slide, slide 17. So as I mentioned, Form S3 has that $75 million $75 million public float requirement. Now there is an exception for those smaller companies that can use Form S3 or F3 on a limited basis, and they are what's called subject to this baby shelf limitation. So an issuer that has an aggregate market value less than 75 million can take advantage of instruction IB6A of Form S3, which limits essentially the amount that issuer can offer to a third of its public float during any trailing 12-month period. So this 1/3 limitation applies to securities sold in any primary offering, including an ATM offering. So for issuers that are subject to this baby shelf rule, the full amount available under an ATM program, even the portion that remains unsold. So if an issuer puts up a $50 million ATM program and only uses $1 million of it, for purposes of the baby shelf calculation, that full 50 million is used because it's all technically being offered, even though it's not being sold. All of it counts against the issuers in terms of calculating its 1/3 limitation, which can be obviously quite inherently punitive. So to calculate the public float for purposes of the S3 eligibility, an issuer can look back 60 days and select the highest of the last sales price or the average of the bid and ask on the principal exchange in order to calculate its that public float amount, so it can calculate that 1/3. That registration capacity is measured for each subsequent takedown. So the shelf availability for a particular takedown is measured as the current allowable offering amount less any amounts actually already sold under the shelf registration statement in prior takedowns. So accordingly, the available amount will increase as the issuer's stock price increases, and conversely, obviously, decrease as that issuer's price decreases. As the public float decreases, that 1/3 amount similarly decreases. So moving on now from setup to now some basic legal considerations on slide 19. So as mentioned, an ATM offering is a registered public offering. The sales agent and its counsel will conduct ordinary due diligence prior to the entry into the ATM agreement and the commencement of ATM sales. Given that ongoing or continuous nature of the offering, the ATM agreement will require the issuer to periodically refresh or provide updated diligence deliverables, including updates to legal opinions, comfort letters, officer certificates, secretary certificates, good standing certificates, all the usual deliverables that one would expect at the settlement of any securities offering. And this is because the sales agent is subject to liability under Section 11 of the Securities Act. Even though it may only be acting as an agent on a best efforts basis, but even notwithstanding that, the level of due diligence required is the same as it would be for a firm commitment underwriter. So next slide, slide 20. The activities of the distribution agent may more closely, as I mentioned, resemble ordinary dealer activities. First, the distribution agent executes sales of those securities in those brokerage transactions, which don't have any selling efforts. These are all positive facts to negate a finding that the agent essentially is considered to be a statutory underwriter. But notwithstanding that, as I mentioned before, ATM programs do have the flexibility for principal trades. So if the agent does engage, perhaps there was a reverse inquiry or some other matter where the agent does find itself engaging in special selling efforts, it may require compliance with Reg M, notwithstanding the ability to rebut that in the context of a pure agency role. So next slide, slide 21. So issues for a continuous offering, both the issuer and the agent need to be obviously mindful of the anti-fraud provisions of the Securities Act. This is especially true, as Zach mentioned, because the issuer cannot be selling securities through the ATM at a time when it is in possession of material non-public information. So importantly, many, especially affiliates of issuers, have established ATM programs with a 10b5-1 plan stapled to the program. So 10b5-1 plans provide an affirmative defense to any insider trading allegations, which is helpful in order to permit sales to continue to go during periods that would otherwise be classified as blackout periods. So slide 22. Prospectus delivery. So of course, an ATM offering is a primary offering if done by the issuer. And so there's a prospectus delivery obligation. Brokers selling on behalf of an issuer may have a obligation to deliver the prospectus to their clients, but happily, access equals delivery in the ATM context too. And so this is usually satisfied by the public filing of the ProSup. Slide 23, Reg M considerations. An ATM offering that is being done by an issuer that has securities that qualify as actively traded have a lot more flexibility, obviously, under Reg M. And this is true of most issuers that set up ATM programs, is that they have securities that qualify for this Reg M exemption. And the exemption for an actively traded security is defined as securities that have average daily trading volume, or ADTV, of at least $1 million for an issuer with a public float of at least $150 million. So if you reach that level, then you are not subject to the restrictions of Rule 101 of Reg M, which is very helpful. In the case of securities that do not meet that exception, and there are examples of ATMs with smaller issuers that don't hit that amount, each ATM offering itself needs to be analyzed by counsel based on the magnitude of the offering and whether the offering itself involves any special selling efforts by the applicable ATM agent in order to assess whether Reg M restrictions, including Rule 101, is applicable. Notwithstanding the ADTV exemption that I mentioned, Rule 104 of Reg M prohibits stabilization activities by the sales agent in connection with the ATM offering. But typically that's not applicable, as most ATM offerings are done on a best efforts basis and are therefore exempt from the short sale restrictions of Rule 105 of Regulation M. So next slide. So in addition, especially because of Reg M, prior to conducting an ATM offering, the issuer needs to make sure that any ongoing repurchase programs or dividend reinvestment programs are suspended. The issuer should obviously not be issuing securities at the same time that they are buying back securities. That's very important. So an ongoing repurchase program, as expected, is a program that many public companies have adopted to purchase back their own securities, either directly or indirectly in the open market. A DRIP, a dividend reinvestment program, is an automatic reinvestment of an issuer's shareholders' dividends into new issuances of the issuer's stock. So if the issuer has any sort of ongoing plan like that in place, it should be wired into that ATM agreement to ensure that those programs and plans are automatically suspended or limited to a predefined time period that does not overlap with the ATM program. I mean, typically for DRIPs, that's not a problem, as a lot of dividends are announced, issued, and done near a company's issuance of earnings, and typically the company is in that blackout period anyway. But that's just another point to keep in mind. Section 5, so restricted lists. Sales agents participating in an ATM program need to consider how to address their participation in the ATM program with respect to any other activities, any banking activities that agent is working with the issuer on, whether that be advising in terms of a fairness opinion or any sort of other advisory services that are being provided by the agent or the agent's affiliates to the issuer. Most compliance departments do insist upon having some sort of restricted or watch list of issuers that they have ongoing ATM relationships with. Slide 26. So research is a very important point, especially for, really both the issuer and the sales agent, to understand the limitations with respect to the ability to cover issuers if the agent has an ongoing ATM with them. So the agent can generally participate in an ATM offering even if they do provide research coverage. And this is Rule 139A of the Securities Act. This permits sales agents to participate in a distribution of securities so long as it meets the requirements of S3 in order to publish that research report regarding the issuer. If so, then that can be done in the sales agent's normal course, assuming they have a reasonable amount of regularity with respect to the issuance of their research reports, and they're not providing an undue amount of prominence to the issuer in that research report. That a research report needs to include information that's similar to a substantial number of other companies in that industry. It shouldn't be just covering just that issuer and shouldn't be giving any more materially greater space or prominence than it would to issuers of other securities in the same industry. So slide 27. In those instances, conversely, where the sales agent doesn't already have research coverage, the question, may arise whether that sales agent can commence research coverage during the term of the ATM for the first time. So there's relatively little guidance on this. So, most deal participants analogize to a underwritten offering, which limits the ability to commence research to a 3-day period. So typically research cannot commence earlier than 3 calendar days following the establishment of an ATM offering. Sales agents are generally advised to institute, guidelines regarding that review process to ensure that any securities that are being that are subject to an ATM that the issuer is involved with, the compliance department knows whether the research analysts have been issuing research with respect to that issuer, or if a new research report would constitute the commencement of research. Last point on slide 28 here, I mentioned earlier kind of conflicts issues. Certainly the sales agent needs to keep track of any independence issues. When the SEC, FINRA, and courts have considered the independence of financial advisors, they've mostly focused on whether the advisor has received or is expected to receive a success fee in connection with the consummation of the transaction at issue. So if that is the case, there very well may be a conflict at play. Flipping over now to selling stockholders, and we'll cover this fairly quickly as we're running short on time. So I've mostly talked about ATMs that are done by issuers set up, but they can also be set up by significant affiliate or non-affiliate selling stockholders of the company in order to take advantage of market opportunities to sell shares quickly. The main benefit here is that you get out of the Rule 144 limitations. So in Rule 144 resale land, significant shareholders are limited to sales of securities during any 3-month period that don't exceed, the greater of 1% of the issuer's outstanding shares or the average weekly trading volume during the preceding 4 calendar weeks. So if there are potentially significant sales, an ATM for a selling stockholder could be beneficial. Slide 32. This is where that Rule 10b5-1 plan can be incorporated. In order to establish that Rule 10b5-1 plan, the selling stockholder needs to specify the amount, price, and dates that it wants to make the sales. It needs to include a formula or some sort of method where the agent will know, how to consummate those sales. And it needs to give the exclusive right to the sales agent to determine how, when, and whether to make sales on behalf of the selling stockholder. The next couple slides here deal with Section 16 filings. Obviously, if you are an affiliate and you have an ATM program set up, you are still going to be subject to Section 16 and the Form 4 filings that accompany it. If there is a 10b5-1 plan stapled to that ATM, it would be beneficial for that affiliate shareholder to note that in its Form 4, obviously, to avoid any insider trading concerns there. Slide 34. If the selling stockholder obviously is not an affiliate, then no need for that 10b5-1 plan, no need to worry about Section 16. But nonetheless, Section 16b, wouldn't be applicable as well. Slide 35. think we covered a lot of this. The only point that is worth noting is that even if you're not subject to Section 16, you may be if you are a 5% holder and establishing an ATM. You may be subject to Schedule 13D or 13G filings. So that's something that may be applicable in certain contexts. So our final section here just covers special considerations. So I'm on slide 37 here with respect to closed-end funds. So a closed-end fund is a type of fund that has a fixed number of shares that are usually listed on a major stock exchange. So in contrast to open-end funds, they are listed because they do not, issue and redeem their shares on a continuous basis. So basically, their holders are trading on that stock exchange. Because of that structure, closed-end funds can also benefit by having an ATM program as well. But there are certain special considerations because of the regulatory nature really of the closed-end fund that one needs to be mindful of, particularly as reflected on the next slide, Section 17. So Section 17 of the 1940 Act prohibits a closed-end fund from certain transactions involving investment companies and their affiliated purchasers. And so the important point here is that an affiliated purchaser can include a principal underwriter of the fund. And so an analysis needs to be done on whether that ATM agent is acting in the role of a principal underwriter. Again, this goes back to the conversation, the point that I was making earlier with respect to having an ATM set up just to do agency best efforts trades, or also to have the flexibility to do principal firm commitment trades. The former, will likely present less of an issue potentially for an ATM program that's just done on an agency basis to rebut perhaps the presumption that that agent is acting as a principal underwriter to the closed-end fund and then subjecting itself to Section 17 of the 1940 Act. So important point there. So slide 39, there are some alternatives, obviously, to get out of Section 17 question in the context of an ATM, like I just mentioned. But it really is a facts and circumstances analysis that all parties just need to be aware of. There have been several no action letters, Pilgrim amongst others, and there have been several closed-end funds that have set up ATMs. We've done several here at Mayer Brown. So it's just something that needs to be thoughtfully structured. Slide 40, business development companies. Worth noting here, business development companies or BDCs are investment funds that invest primarily in private and smaller public companies. Historically, BDCs faced many challenges raising capital due to regulatory constraints that were imposed upon them by the 1940 Act and by limitations that the SEC imposed on BDCs through the Securities Act. But in 2017, the Small Business Credit Availability Act was passed, and it was just recently fully implemented in August of this year. And so what this did is this implemented securities offering reforms and communication reforms that essentially BDCs are now able to take advantage of in order to offer securities. So BDCs are now able to take advantage of a lot of the registration and the securities offering processes that I've described earlier today in the presentation, whereas previously, before August, BDCs could not. They could not, for instance, incorporate by reference. They could not use the prospectus supplement. And so an offering by a BDC, if they wanted to set up an ATM offering, was much more constrained and difficult and costly. So now that we've got these new securities offering reforms, BDCs especially are more able to set up ATM offerings. In particular, the SEC adopted the ability for BDCs to act as WIXIs. As mentioned earlier, the ability to be a WIXI allows one to set up an ATM program much easier. And many BDCs do meet that $700 million qualification number that I mentioned in order to benefit from WIXI status. Similar to operating companies, BDCs are now able to engage in a streamlined registration process. So they can use the essentially a new short form registration statement, very similar to S3. It's on Form N2, which is a different registration statement that investment companies use, but nonetheless, it now has wired into it a process that is analogous to the S3 short form registration. Rules 172 and 173, which allow for that access equals delivery. As I mentioned, that prospectus delivery requirement is somewhat easily satisfied now, but BDCs can now take advantage of that as well. So in lieu of delivering a physical copy of the prospectus to each of its investors, the BDC can now take advantage of access equals delivery. Obviously, that inherently cuts down, on the costs of doing a securities offering. BDCs can now incorporate by reference. As Zach and I have worked on many offerings where the ATM prospectus supplement is fairly skinny because really the ProSup is incorporating by reference all of the company's public disclosures from its 10Ks and 10Qs and 8Ks into the ProSup by reference. Unfortunately, prior to August, BDCs were not in a position to incorporate whether it be backwards or forwards. So every time the BDC needed to do a takedown off of its ATM, it needed to fully update that long form prospectus. So that's a big cost savings for BDCs there. And then finally, BDCs are now able to rely on the communication safe harbors that have always been made available to operating companies. So these communication safe harbors include the ability to make certain offering communications prior to having an effective registration statement. It allows BDCs to communicate more with broker dealers that issue regularly published research on the BDC. And it allows the BDC to release certain factual business information frequently. So once all of these changes have now been effective for a period of time, we would expect the operating costs for BDCs to be reduced, and this will likely lead to an upswing in the number of ATM programs that are set up by BDCs. With that, the last couple slides that we included in the presentation really is just a sample timeline and an example of the documentation that's required in the typical ATM process setup, really just for your reference. And so with that, I think, Zach, unless you had any other closing thoughts on any ATMs perhaps that you and the BMO team have recently been involved with that you want to share?
No, I think, we're running out of time here. But, I would just say the proliferation of this execution alternative continues to grow. And I think we're just going to see more and more of it as issuers find it's a super easy and convenient way to raise capital. Excellent.
Yeah, totally agree. We really thank everyone for joining us this afternoon. Please be well and have a good rest of your day. Thank you.